The long-held stock market adage, sell in May and go away, didn't hold true this year. Risk markets did well across the board. Fun fact, the S&P 500 index recorded its best May performance since 2009, when markets rallied off its worst levels of the global financial crisis in March that year. US core inflation was up moderately in April and consumer spending weakened. This has helped to raise expectations for rate cuts this year. We believe there are good reasons to expect continued downward momentum for inflation. Recent employment numbers have come in below expectations, while consumer sentiment surveys indicate falling confidence. Nonetheless, a prolonged period of persistently high interest rates remain a key risk for markets, particularly as political and geopolitical risks ramp up. As the Dragon Boat Festival races in full swing this month, we see regional clients fueled by optimism as an overweight view towards equities now lead the pack. Preference for US, Japan, and technology stocks continue to propel ahead. But in a thrilling twist, China has gained momentum as a formidable contender. Sentiment has turned, propelling Chinese equities with a rising number of investors now positive on the market. If you have yet to notice, several Chinese markets have outperformed major peers since the Lunar New Year. Much like the drummer's rhythm that drives the peddlers, the call to broaden exposure towards small, mid-caps continues to ring louder. While in fixed income, quality investment-grade bonds remain steadfast favourites as rate cut expectations stabilise. The abrupt change in macroeconomic regime post-pandemic has made cash a tempting option for income investors. But here's the problem. Rates are high because of elevated inflation. With potentially lower inflation, rates are likely to fall. This will impact cash returns. Defensive assets with an income focus, a key investment theme for Q2, is all the more relevant in prevailing markets. We highlight two areas where investors can consider deploying capital. The first is high-quality US investment-grade bonds. The experience of holding bonds in 2024 has been one of unrequited anticipation. The persistence of US inflation has caused a delay in rate cuts, while other asset classes like high-yield bonds have outperformed. In our view, the stage is now set for a period of investment-grade bond outperformance. Investors can lock in attractive yields without taking excessive risks, and these investment-grade bonds tend to do well in interest rate cut cycles. The second is in Asian dividend stocks. Equity income investing is back in vogue after a long period where markets seem exclusively interested in technology and growth plays. Their dividends will become more valuable as interest rates decrease. We believe greater opportunities for income investors lie in Asia, where the continued stabilization of China amidst increased policy measures can support Asian companies' cyclical earnings and dividend growth. Structurally, there are growing policy measures pushing for more dividends and share buybacks across the region, led by Japan, Korea, and China.